Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo. On today's episode, you're just getting me, so I apologize up front. On today's episode, I want to talk about investment portfolio, specifically around diversification and asset classes. And what I mean by asset class is the different types of assets that you can own. Asset class would be like real estate is an asset class. United States large companies is another asset class. United States small companies is another asset class. And the reason I want to go over this is, as we are going over different portfolios with prospective clients, we constantly see one thing. And the one thing we always see is this asset allocation where it's very highly targeted in one specific asset class. And while sometimes that's great, at least in individual years, over the long haul, it may not be so great. And so I want to go through a tool that we utilize to talk about this with our clients. And I thought it'd be very valuable for our listeners to hear this as well. One note for our listeners that are just listening on the podcast alone, make sure you check out the YouTube channel because the video side of this, I think, will be very important to see. So without further ado, what I want to do is I want to share my screen, and we're going to look at investing $100,000. Okay. So this is a tool that we utilize to kind of show how different asset classes perform. And, a lot of people will try to pick and time the market. It could be used for that as well. But for today's episode, you can see the start year is 1973. I took a 50-year study period. And if you had $100,000 and you had invested in one particular asset class, where would you have put it over the 50 years if your goal is to grow that $100,000 as aggressively as possible? And so you can see these asset classes down here below. We've got United States Treasury bills. We've got long-term government bonds, United States large stocks. By the way, that's the S&P 500. Right? The S&P 500 is made up of 500 United States large companies. Then we've got US small stocks. We've got large value. So value is different than growth. Value is companies that is based more on profits. That's their goal, is more profits than growth. We've got small value, international large, and international value. So back to my original question here. If you had $100,000, which one of those asset classes would you have chosen? Most of the time when I ask this question, inevitably people go to United States large stocks. I'm not going to lie, it's a great investment. Your $100,000 would have turned into almost $6 million over that 50-year period of time. And if you're looking at the reds and the green, red doesn't mean negative necessarily. It just wasn't the best asset class that year. The green shows that it was the best asset class that year. So for instance, 2019, the S&P 500 is 31.43%. That was the best asset class that year, which is why it's green. So this is the S&P 500. It's what a lot of people have 40, 50, or even sometimes 60, 70% of their portfolio is in this one asset class. And it makes sense. This is the asset class that, when you hear the media heads talking, they always talk about, well, the S&P 500 was up or the S&P 500 was down. So a lot of people almost consider that this is the market, even though the market is global. This is just an asset class inside of the overall market. So your $100,000 grows to 13.5 or almost $13.6 million. Here's what's interesting. If we chose U.S. large values, so these are companies focused on profit, you would have doubled your money, $32 million. Okay. I'm going to take this a step further. Why don't we invest in small companies? So now we have 38 million. And I'm going to take this one step further. US small value, almost $107 million. So your $100,000 over a 50-year period grew to $107 million. It's quite a big difference from 13.6. And I'll just show you a couple others here. Here's 30, here's 5, right? But this asset class, US small value, is the best asset class over this 50-year period of time. Yet, oftentimes, we rarely see barely any money in this asset class. We might see 2, 3, maybe 4% of anyone's portfolio sitting in this asset class. Now, I'm not suggesting, I want to be clear here, I'm not suggesting that you put all of your money into this one particular asset class. What I am suggesting is when we talk about diversification and how the market's going to do, we have no idea which asset class is going to be the best asset class in any given year. Like I was just looking through this. In 2022, looking through this here, S&P was down -16, almost -17%. Long-term government bonds was almost down 30%. Here's what's interesting. How many of you knew that U.S. large value was up 4% that year? Right? We can't pick which one of these asset classes is going to be the best in any given year because it's impossible to know that. So we should build a portfolio where we can capture what the market gives us and maybe understand what has been traditionally one of the better asset classes, maybe small values. Maybe build a portfolio with a little bit more than maybe 2% in that category. When I go over this scenario with prospective clients, they're shocked when they see this particular category. And then when I show them their portfolio and they see they've got 2% and then the other 40 or 50% is sitting in US large stocks, it starts to open their eyes as to how diversified they actually are. Which is the whole point of this conversation is how diversified are you? Do you even know? A lot of times we're invested in maybe target date funds or a bunch of different funds, and there's a lot of overlap. Maybe a lot of it's sitting right here in large companies. And so something to consider is really understanding how you're invested and looking at the long-term aspects of this. Because if I take any 30-year period of time, right, if I started in 1973, let's just go 30 years now, right? US large would have gone to 100 to 2 million. And again, small value is 13, almost 14 million, right? If I go to 1980 and go out 30 years, look at this again, US large, 2.4, small value, 8.7, international is 1.8, international value is 5.7. You can see the difference here, right? So why are we not looking at our portfolio from that standpoint? How are we diversified, like truly diversified from an asset class standpoint? So I wanted to go over this with you. I think it's a key ingredient when it comes to looking at your portfolio and understanding how you're invested. The question of the day that I've got for you today is, when's the last time you looked at your portfolio from this standpoint in terms of analyzing how diversified you are and what asset classes you own? Head over to beerandmoney.net, and that is a great spot to either answer that question or if you've got questions stemming from this episode. It's great. There's a contact us at the top where you can ask us your question. We get a lot of the questions on that site, which is what stems these episodes. We appreciate that. Look, we started this podcast to bring you value, our listeners, so that you can build the life that you want and live that life. We hope this episode was valuable for you. And as always, make it a great day.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806. Pinpoint number 2024-170117. Expiration February 2026.